Hello and welcome to On the Mark Financial Literacy with Mark Zinman. Today's episode we are going to be speaking about the tax implications of selling real estate. Hello, Mark.
Good morning, Monica. Morning, Lisa.
Hello, Alicia.
I want to share before we start that I get more rules and notes before we start these shows than my granddaughter bosses me around, okay? So I just let you know, yeah.
So let's start with the question.
Yeah, that'd be great.
Okay.
Because I think that question will help us lead into this whole topic.
Absolutely. Okay. So here's our question. Terry in Nashville asks, in helping my friend with her finances and sale of her home of 45 years, I was exposed to the capital gain rules, particularly those following the death of a spouse. The house is going on the market and should sell before the end of the year, so can you explain capital gains exposure and rules as they apply to home sales and tax?
Okay. Well, I'm going to start off with a little bit of a high-level thing about all real estate sales and then get into particular kinds, okay? So anytime you have a sale, it could be a home, it could be property, it could be stock. The gain that you pay on is the difference between what you sold it for, net of any costs, and what you paid for it. So if you buy a stock for $20 and you sell it for $40, you have a $20 profit, and the profit will be measured on number of shares you had, 20 times the number of shares. And then there's two holding periods. There's a short-term and a long-term gain. Okay, short-term is pretty easy. Anything less than 365 days is short-term. So if I buy something on June 1st and I sell it on May 31st next year, it's short-term. If I sell it on June 2nd, it's long-term. If I sell it on June 1st, don't do that because then we have to count the days, okay? Leap year or not leap year, but it's basically 1 year. And then anything longer than that is long-term. And there are short-term gains or taxed as ordinary income, same as wages or dividends or interest, and capital gains have a special rate. And the easiest way to think about capital gains is usually half of your marginal tax rate, usually 15 or 20%, depending on the type of gain you have. So let's talk specifically real estate. There is three kinds of real estate that a person would have. They would have a primary residence, they could have a shore home or a vacation home, and they could have a rental property. And those are all residential properties, all owned by individuals, and they have different tax rules. So let's work our way backwards. The rental property, okay? A rental property is one where you collect rents for any number of years, and then you make improvements, whatever, you sell it. That is the most complicated way to figure a gain. Why? Because it has other things included. So you have your rental income minus all your rental expenses. If you have losses, in some cases, I don't want to get too complicated. In some cases, if you have losses on rental properties, you can't deduct them. There's passive loss limitations, and that's called a passive loss. So they may carry over. But when you sell the property, it's the same thing. It's net sales proceeds minus basis. But basis is a much harder calculation than a rental property, and you should probably use a professional because I'll give you examples that affect basis. So I bought the house or the residence that I'm renting, and I rented it out for 5 years, and now I'm selling it. Well, in the 5 years, I depreciated it. And you can depreciate rental real estate over 27 and a half years. So that would reduce my cost basis. And then I also put new windows in there, and I did some other stuff, so that might increase our basis. So there is a tracking that you would have, and normally in a rental property, because of the way that it's reported on tax returns, you tend to track it better than you do anything else. Because you put new windows in, you're going to want to depreciate them. You put a new roof on, you're going to want to depreciate it. So it's information that you would give to a tax professional, or you would enter into your tax return that you prepare, so it just kind of carries over year to year. That would always be long-term capital gain as long as it's longer than a year. There is no exclusion. The only thing that you could do, and I'm going to name terminologies, and hopefully, Monica, you can help me if you need to explain more, is the only way to defer a gain on a property that's rented out is what's called a 1031 exchange. And people have heard that million things, and I want a 1031. People want a 1031 everything. 1031 refers to an IRS code section that allows for the rollover of gain or deferral of gain. It is a very particular it's not particularly complicated. You have to follow certain rules in order to get that rollover. And you would hire a company called a 1031 company who would help facilitate that exchange. What do you mean by facilitate? Well, I mean that you're never going to buy and sell a property on the same day, but you're going to sell property A. You have to identify property B within a certain period of time of A, and you have to settle within it. There's like 45, 100, there's a bunch of days, and that's really important because you don't want to miss by a day. And as long as you time it out, it's not hard to do. But you also, let's assume that most people would sell property A first before they property B to have the cash. So if you're going to sell property A, you can't touch the money. So an escrow agent will have to hold that money and then give that money at the table when you settle property B. I do want to explain, because this is like one of the things that drives me nuts. Taxes are not bad.
Don't go anywhere. We'll be right back after a quick break from today's sponsor.
De Novo HR Consulting and Business Advisory. When your business is growing fast, you need more than just people. You need the right people, the right systems, and the right strategy. At De Novo, we partner with organizations like yours to build smarter, stronger teams. From executive coaching to health and safety audits, from mergers and acquisition support to HR compliance, we handle the details so you can focus on the big picture. Whether you're hiring, training, or transforming, De Novo HR is your trusted partner in progress. People first solutions, business forward results. Visit denovohrc.com today.
Like, I want to not pay taxes. How can I not pay taxes? Okay, taxes, and I've said this probably in a prior episode, taxes are the result of an economic transaction and not the reason to do it or not do it. Okay? Because taxes for the wealthiest 1% is 35%, excuse me. For most people in my audience, you're probably looking at 22 or 24% marginal tax bracket. I mean, that's a wide range of middle income people in that bracket, and maybe a little higher middle income people. So you're talking about 22 or 24%. So you need to, there is a decision to make. Do I pay the taxes now or do I pay them later? Because eventually you're going to pay them. Because when you sell that second property, you're going to pay a gain, and the gain is going to be measured on your basis in that property is going to be reduced by, so I buy a new property for $500,000. I have a $100,000 gain that I didn't pay. What's the basis of the new one? $400,000. So you're eventually you're just rolling it forward. Mm-hmm. And I have had intense arguments with clients about, I don't want to pay taxes, and sometimes it's better. Like, there was a period of time back around maybe 6-7 years ago when rates on dividends were capped at 15%, so it was easy to kind of clean out some companies and just pay it, because you're never going to be, and it has never been lower. So yeah, I might have had a corporation where I had undistributed income. I distributed $100,000. It cost me $15,000. You distribute that money now, it could cost you $24,000. So it was worth it. So that's we've talked about rental property. Do you have a question on that?
I do have a question. Maybe you could explain what differentiates a rental property from a vacation home. In other words, let's say that Alicia has a vacation home down the shore. And she herself vacations in that home, and when she's not there herself, she rents it out.
Great question. If you occupy the house for more than 14 days in a year, it is still a rental property, but subject to even different rules about losses. You can only write off the expenses related to the rent you received and not all the expenses. So it gets a little more confusing, and we're going to go into the second home thing. It would become more of a quote unquote second home, the treatment of that. So yeah, that's what and it's, in reality, it's not, I rented it, nobody rented it, so I used it for a week. It's basically, if you're occupied for more than 14 days, it really doesn't count. Now, who keeps track of that? Don't know, but I'm just giving you the rule. So I see that a lot with vacation properties where people will rent it out or use it on an off week and whatever, and that's fine. If you rent it out for a week or two, it's the same rules as I just expressed for a property. And you could have, theoretically, a shore property or a vacation home that you rent out for 5 years, and then all of a sudden you decide, I'm not going to rent it out anymore. That happens too. And then what's that? Well, your basis in that would be the depreciated basis, right? So you bought the thing for $500, you wrote off $100. Now when you go to sell it later on, your basis is $400, and that just carries through. And it reverses the other way too. I bought a house and now I want to rent it. So there's lots of conversions, but what we're talking about here about sales is what was it when I sold it, okay? And obviously what it might have been or how a thing would affect the gain, but it doesn't necessarily affect how it's treated. So second homes. Second homes, vacation homes, short homes, whatever, depends on where people live. What we're talking about is a house that isn't rented, but isn't your primary residence. What's a primary residence? A primary residence is a place where you sleep for at least 181 days a year. Okay, so it has to be more than 6 months. There are other factors that factor into that, like where's my license, where's my mail go, where I file my tax returns, where my cars are insured, all those other things, because we're registered to vote. And we have a lot of it, I don't know if it's all over the country, but certainly on the East Coast, we have sunbirds, people who go to Arizona and Florida for the winter, and their taxes are less than our state, so they don't want to pay our taxes. They want to become I want to be a resident. Well, it's a fact-based determination as opposed to a desire. And it's even worse than that because, and I've told clients this all the time, so years ago, the way that it was done is people would keep a calendar and say, oh, these days I was in my vacation home, and of course, they theoretically could be truthful or not truthful, and regardless of whether they were or not, nowadays it's Big Brother. So I have been involved in audits where they have pinged where the Easy Pass was. They have looked at where your credit card's charged. They looked at what cell towers your cell phone came out of. I've been through New York City audits. New York City's an island, Manhattan's an island, so everybody has to go over a tunnel or bridge to get into it. Easy Pass. So that's their most common is they use Easy Pass. You have to go in or out, and you pay both ways, so it's easy for you to figure it out. Anyway, back to second homes. So second homes are kind of the same thing as the first one. It's going to be your net sales price minus your cost basis. And for both principal residence and secondary residences, the cost basis is going to be what I paid plus all the improvements. Now, quite often in this situation, you don't record it because it's not a rental property, so it would be nice to keep some records, but basically, and we're going to get to the 45-year person who probably doesn't remember having receipts for 45 years ago of what they did. I tell clients, sit down, close your eyes, and walk room to room and tell me what's different in that room now than when you left. And to the extent that you can put a value to that in the current dollars, it's usually acceptable. Obviously, having receipts is the best thing, but if you got audited and had something reasonable, maybe pictures would help. If you don't have the receipts, something. And that's for both rental properties and principal residences. For a rental property, you're going to need to probably have the receipts. But again, that's the gain. And there is no deferral on that gain. There's no 1031 exchange, there's no deferral. You're just going to pay tax. Other thing to be mindful is if your rental property is in a state other than where you live, you're probably subject to the state's tax. So here, I'm recording from Pennsylvania. We have a lot of people, we keep saying shore, we have a lot of people that go to the Jersey Shore. New Jersey actually withholds 2% of the sale price for non-residents to force you to pay the taxes. So in the instance of Pennsylvania, New Jersey's taxes are much higher than Pennsylvania. So what you would do, and this will come up in maybe other things we talk about, when you're a resident of a state, you're required to report all your income to the state you live, regardless of where you earned it. But you get a credit against your current state at the current rate for the tax you paid somewhere else. So the rate in Pennsylvania is 3%. New Jersey could go up to 9 or 10%. So normally the New Jersey tax would be higher than the Pennsylvania tax. So you had that $100,000 gain. You paid tax, maybe you paid $5,000 Jersey, 5%, okay? You get a $3,000 credit to Pennsylvania, you really don't pay tax twice. And people might it's sort of the same kind of thing with foreign tax credits on dividends, if anybody has seen that. Now we go to personal residence. Okay. This is probably the area I get the most questions because everybody, especially if you're older, everybody remembers what the old rules were. If you're younger, maybe you didn't know what the rules were at all, but people like Terry, who are older and they lived there 45 years, they remember the old rule was you got a once in a lifetime exclusion on the gain of a principal residence and you had to be there a certain number of years. That was $250,000 for a single person or $500,000 for married filing joint. They changed that rule several years ago. It's now not a one time, it's every time. So as long as you were in that house as your principal residence for 2 out of the last 5 years, you qualify for deferral. So the calculation is exactly the same. Net sale proceeds minus basis, which is go through every room, figure out what you did, gives you a number. If that number is less than $500,000, it's a special tax form you have to fill out, and you have to certify that I lived there, and obviously that's something that could be checked, but we're just assuming truthful here. You would do that. and you can exclude the 500,000, and most states recognize that as well. Now let's go to Terry's situation, which is a more complicated one. The difference with Terry's situation is that you have a house owned for 40-some years by joint people, one dies, and somewhere in the future, the person sells that house.
Yes.
Okay, so this gets into a whole another area, and I'm just going to 150 foot it here, estate taxes, okay? So when you die, your assets get what's called a step-up in basis. Most of the assets have appreciated. Your house is worth more than when you bought it years ago. Your stock hopefully is worth more than when it applies to everything. So basically, when somebody dies, the executor takes an inventory and files a return, maybe with the state or some kind of a thing, and you get a step up in basis. So we take that house, okay? So the house was bought for, maybe it was bought for $100,000. And when the person, when the husband died, it was worth $500,000. So what's the basis? Well, the wife's basis is $50,000, right? Half of 100, okay? Because she's joint owner when they bought it. And the husband's would have been 50 had he been alive, but now he died. House is worth 500, so her basis is 250. So what's her basis in the house? 250 plus 50. The only other thing that applies is that now, if she doesn't sell it within 2 years of his dying, she doesn't get the 500,000. She goes back to 250. And so therefore, if she sells a house and she makes more than $250,000, she will owe taxes on it. So we define several terms here. We define what's a capital gain, and then whether you have a gain or not, based on what kind of house you have, whether you do a 1031 exchange or something, you're going to have to when you pay the tax. By the way, when you have, I'm going to throw out a bunch. You used to have to buy a house that was more expensive than in order to get all that's out the window. It's just straight. I sold my house, net proceeds minus thing, under 500,000 or under 250. No carryover, we just go start with the next house again. Or if you don't buy a house, you don't buy a house. There's no rollover gain, there's no once in a lifetime. I just want to, because people hear things. I'm old enough I didn't necessarily, but they used to have income averaging. And I think income averaging was taken out of the tax rules in 1986. And what income averaging was is that if you had a really good year, and the other year, like you always had a really good year, you could go back and average out the 5 years. I still get asked about income averaging, and what's it, 40 years later, 45 years later? It's just, but things get stuck, especially things that don't apply regularly to people, get stuck in their head. And people aren't selling their homes every day.
So if you raised a family in a 4-bedroom home and it's time to retire and you're downsizing to a smaller home, that's no longer, the cost of the new home is no longer at play.
And that doesn't even factor in. And I will also share with you that I can't tell you how many people have downsized, and actually the new over 55 costs more than the house they sold. So it's not always downsizing, it's sometimes right-sizing. And the other thing I want to express, and this is more from the financial literacy point of view, your house is not an investment. Your second house is not an investment. Why? Because you derive personal enjoyment out of it. Yes, it has a value to it, but it's not like if your house all of a sudden goes from 500,000 to $1 million, that you're going to sell your house and live in a tent because now you got $1 million. A rental property is an investment. By definition, you don't have any emotional ties to it. You're not sleeping there or whatever. If the market's great and somebody comes and makes you an offer you can't believe, you'll be selling in 2 minutes. You may be selling it subject to the renter in there because they have a lease, but hey, you offer me a lot of money for this thing that I'm going to do it. So just keep that in mind, because that's another thing. People tend to think of homes as an investment in the same definition as I own stock, but it's not. A home is just a cost of doing business of being the same way we can talk about rent, right? So you pay your mortgage every month. People pay rent every month. It's just a cost of occupancy. It's not the reason why the house is an investment is you're hoping that that house price will keep up with inflation, so that if you are a young family and maybe the first 5 or 10 years you live in a duplex or a townhome and you want to move to a single family home, that the value of your home will stay somewhat equal from an inflationary point of view of what home you want to go into. When you're retired, it's not as much of an issue because you're picking lifestyle over school district location, stuff like that. You don't have the kids. So there's a difference, but I just want to make that thing because I hear all the time clients will say, well, my house is worth $5 million. I'm like, congratulations, where are you living?
All right, very helpful advice.
Well, it'd be nice if I had somebody who had a house worth $5 million. I think I was a little exaggerated. I don't have anybody who has a house worth $5 million that I know of, but yeah.
Okay. All right. So again, very helpful information for Terry. If anyone else has any other questions that they would like to ask for a future podcast, we invite you to go to onthemark.cpa and submit your question there. Otherwise, we look forward to seeing you next Wednesday. Thank you for joining us. All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the Mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.